Module 7, Financing Strategies and Cash Flow Management. A. Role of financing in cash flow management. Financing ensures that a business maintains sufficient liquidity to cover operational needs, investments, and unexpected obligations. Effective financing strategies reduce dependency on internal cash reserves while supporting growth. Financing decisions must align with cash flow projections to avoid solvency risks. Insight: selecting the right financing strategy can significantly improve working capital efficiency and cash flow stability. B. Types of financing. Short-term financing typically covers operating expenses and temporary cash shortfalls. Common forms: bank overdrafts, trade credit, short-term loans. Commercial paper characteristics: low duration, flexible, but may carry higher interest rates. Medium-term financing covers need beyond 1 year but less than 5 years, often for capital projects or expansion. Examples: term loans, leasing arrangements, hire purchase agreements. Provides predictable cash outflows, but requires careful planning to avoid liquidity stress. Long-term financing supports strategic growth, infrastructure investment, and large-scale acquisitions. Examples: bonds, equity financing, retained earnings reinvestment, venture capital. Pros: stability and long-term funding. Cons: potential dilution of control, equity, or debt obligations. C. Financing decision considerations. Cost of capital, interest rates, fees, and equity expectations must be analyzed relative to cash flow benefits. Maturity matching: align financing duration with the expected life of assets or operational requirements. Risk assessment: evaluate the impact of debt financing on solvency and financial flexibility. Cash flow impact: assess how repayments, interest, and covenants influence short-term liquidity. Strategic alignment: ensure financing supports operational efficiency, growth plans, and risk management. Insight: poorly timed or misaligned financing can increase risk and compromise liquidity even if the business is profitable. D. Financing strategies for working capital conservative financing. Long-term financing used to fund both permanent and temporary working capital reduces risk of liquidity shortages but may increase financing costs. Aggressive financing: short-term financing for temporary working capital. Permanent capital is minimized. Lower financing costs but higher risk if cash flows are insufficient to meet obligations. Matching strategy: moderate. Aligns financing maturity with working capital needs. Short-term for temporary needs, long-term for permanent needs. Balances risk, cost, and liquidity effectively. E. Integrating financing with cash flow management. Cash flow forecasting: identify funding gaps and determine financing needs proactively. Liquidity monitoring: ensure debt repayments and interest obligations do not strain operational cash flow. Working capital optimization: use financing strategically to free up internal cash for investment or operations. Scenario planning: evaluate impact of different financing options under best case and worst case cash flow scenarios. Example: a company facing seasonal cash flow fluctuations can use short-term credit facilities during peak periods while relying on retained earnings or term loans for long-term expansion. F. Challenges in financing and cash flow management. High financing costs reduce profitability. Mismatched financing maturity causing liquidity stress. Over-reliance on debt increases solvency risk. Underestimating cash flow requirements leading to missed obligations. Limited access to financing sources, particularly for small and medium enterprises. Module insight: effective financing requires strategic planning, careful cost-benefit analysis, and integration with cash flow projections.